All right, let's get started. Welcome, guys, to the Gateway Crossing Investment Overview. You're here with myself, Chad, founder of Focus Capital, and Chad Olsen, VP of Investments at the firm. Thanks for your time tonight. Appreciate it so much. Tonight, we're going to go over really four main parts of this opportunity. We're going to cover the opportunity itself, the market, and the business plan. We're going to have a Q&A at the very end, obviously what it means for you, an investor, how you get paid, how that process works, and of course, next steps. So any part here during this process, you have a question, you can put it in the Q&A or the chat, and we'll answer those as we go along, or save it at the very end for the Q&A session. Awesome. So let me share my screen here with you guys. Let me have Chad Olsen do a quick intro for you guys. Chad, you go ahead and introduce yourself, please.
Yeah, I'm Chad Olsen, VP of Investments at Focus Capital. Handle anything from the acquisition side to the debt placement on our acquisitions. This one, Gateway Crossing, being our most recent opportunity that we've been working on for the last couple months. That buttons up right with our closing out of Heritage a few months ago that some of you are probably very familiar with.
Awesome. Thanks, Chad. Well, I'll kick this off here, guys, for you. So, we didn't plan this year starting off with acquiring two properties back to back. That wasn't our intention at all. And this one really just presented a good opportunity for us, being in the same market from the same seller. It's got quite a backstory, which we'll go into that more in a little bit here with Chad as well. But this year we remained opportunistic and we found these great deals at just a low basis from sellers that really are forced to sell. And it puts us in a really good spot as buyers and as investors as well. So I'll cover the Gateway Crossing overview for you guys. I probably won't go into a ton of detail on the deck itself. You should have the deck here in your email. If you don't have it all, please let us know. We'll get it emailed out to you. But as a quick high level here for you guys, this offering is open to accredited investors only, meaning it's defined by the SEC. So that'll be clarified here on the deck as well. I'm going to give you a quick overview on the opportunity, and then I'll welcome Chad here to go over some more specifics for you guys. So we are acquiring Gateway Crossing. It's a 160 unit property located 10 minutes from Heritage Square. We acquired that property back in May. And what's great about this property here is really a few different things. One is the basis. As you guys know, in real estate and really anything for that matter, the price you pay really matters. You make your money on the buy most times. And when you can buy an asset like this that's only 4 years old at well below replacement costs, it puts you in a really good position to minimize downside risk down the road and produce a lot of cash flow as well. So for us, the basis we're paying is really attractive at $143,000 a door. We've got a very low assumable fixed rate loan we can assume at 3.53% for 7 more years, which helps with the cash flow. And of course, the market is terrific. The Louisville MSA market, especially the Southern Indiana area with Sellersburg and Clarksville and Jeffersonville. Yeah, all of those jobs coming in, we'll discuss here in a few minutes, but that presents a lot of opportunity and great renter demand for the area. And of course, the last thing for us that's really special for us is now we have economies of scale to manage both assets within 10 minutes of each other over 340 units, which will help us decrease the payroll costs on both sites. So we have a $6.5 million offering size here for equity. We're about halfway there right now as of today for commitments. It was built in 2021. We're projecting conservatively a 15% IRR for your investment. Average cash on cash return is 7.5% during the whole timeline, and equity multiple of between 2 to 2.44 on your investment dollars, and hold period plan between 5 to 7 years, and symbol rate debt 3.53%, and minimum investment $100,000. Chad, next slide here. Let's go over really, why Gateway Crossing and what's exceptional about this property here.
Yeah, so some piggybacking off of a lot of what you just said, but it's the basis going in, right? So on this one, we're at 160 units. We're 143 a unit. If we compare that to Heritage, we're under Heritage that we just acquired that one out. And we priced that in through a negotiation, and it's been a very long negotiation on this deal the last few months as we were closing out Heritage. But we said, hey, this is our price. This is an older property. This is why this should trade for what it is, and all that stuff. Great location. It's a more idyllic location in some ways where we're even closer to downtown Louisville. But that's why we were able to get it in for this good a basis. And including that, and you're kind of mentioning that on the top line, is we also have an office space that we acquired with it. So that was used by the current seller. He's vacated the office in the last month or so. And we wanted to make sure we maintain control of the entire property and any of the buildings on the site. We want to know who the tenant is going in there to try to enhance the property to the best of our ability. So when we factor that in and we get that leased up, that's going to reduce our all-in basis on the apartments as well. That's not really getting factored into the price right now, but it is looking at that from the income. That goes into the same thing that we talked a lot about on Heritage, but basis wise, 140K a door is a pretty big steal compared to the comps that are on the market and then what it costs to build. So costing to build is shown there is around 160 to 180K for per unit in hard costs. That doesn't include soft costs, land costs, your fees, margin, all those other things. And then that starts to take up well over 200,000. The comps that we've seen sell in this market, there was one in January that was a larger garden style property, sold for about 187K a unit. There was another property that was on market for the high 180s as well. And then we've heard a lot of conversations about other groups that will need to come out to market in the near future, next year or two. They'll be looking to exit above 200,000 a unit. And then from our own thing, being in the market, looking at as many deals as we do, there's deals that are 90s deals, 2000s deals, vintage, that are in Lafayette or around Indianapolis or Bloomington or so on and so Fort Wayne. And those we're seeing transactions of, 140, 160, 180,000 for those types of vintages, depending on the market. So we know that getting a brand new, effectively brand new for this one asset is really in a good spot and really makes us feel confident about it. Same thing that goes to the cap rate. So we're getting at a really good in-place cap rate at a 6, which most new and vintage stuff is trading below a 5.5, fives, even in the high 4s. And we've seen plenty of those transactions this year. We're getting it more at that in-place 6, which gives us that positive leverage conversation. And that's why we're able to show the cash flow that we're showing. I'll skip down after the economies of scale thing to kind of the fixed rate debt that you mentioned, right? So this thing has two different phases that were effectively done. The first phase is about 120 units. The second phase is about 40, but it's all one contiguous site, and you can see that from the map or whatever. They just use that as a way to get some of it recapped a few years ago when they went on to take on agency debt and pay off some of their bank loan. So we're able to take advantage of that one at 3.5% for another 7 years because they took on a 10-year note on that. But what that also enables us to do is on the phase 2, take out a new loan. And that increases our ability to get a little bit more leverage that typically when you're looking at these whole loans, you're dropping that leverage metric down to the 50% or so because so much has been paid down and you're increasing that price that you're going to pay to get that attractive rate. This is really a really good balance that's giving us that ability to lock that in. And then those loans will expire together at 7 years. So there won't be any risk of maturity or staggered stuff like that. But that 3.53 really locks us in since it's such a heavy weight of the whole debt stack that with that smaller loan, yes, we're going to get new loans, we're going to get more proceeds. But even if that rate was to jump up from right now, we would be max at 4.5 all in rate, right? So blended together, those two rates, it's really hard for us to get anywhere near a 4.5. We should end up somewhere between 4.25 or less, which is even 75 basis points better than Heritage Square that we locked in at a 4.96, which was a really great rate to lock in at in the first half of this year. And we got kind of lucky where the market cycle was at that moment in time. But that interest rate risk we were experiencing then, we don't have that now because we've got so much cushion right there.
Thanks a lot, Chad. I think right now would be a good point to go over one of the questions I've gotten quite a few times from investors is about the backstory, about how we're able to get this property at this price. It's not normal to get a 4-year-old property at $143,000 a unit or at a 6 cap. Why don't you go through a little bit of the background on how this whole thing transpired and how it kind of related to the Heritage Square deal we closed with the same seller? Give us like a 2-minute story there if you don't mind.
Yep. Yeah, this deal and Heritage had been out over a year ago in some way, shape, or form, and had gone out with a different broker. They went for a very high price that they did not get. They got offers that were significantly higher than what we're looking at right now, and for whatever reason, the seller decided not to go with those at that moment in time, and so kind of went off market for several months, and then in the fall of last year, we were talking to our friends that are good brokers and good partners and done a lot of business with us, said, hey, we're bringing these deals back out to market. Gateway actually came out first. We looked at it, we went after it, but we couldn't get there with where our price was, still at the price that we're at now. And a different group had taken it down. And then we went after and put most of our energy into Heritage. That went through its cycle, and they went under contract before we were on Heritage. We did our whole transaction on Heritage through January, February. We started to hear rumblings in the spring that Gateway might come back out. And so we just kept the conversation open with the seller. And because of our execution on Heritage and how well we did, how easy we made it for him, and just getting that transaction done, getting it done early, if not on time, and just fulfilling all the promises that we made on our end, right, and being a good buyer. When we came around on Gateway, we were in a kind of competitive scenarios, what we're being told, and we kept to our price and we said, hey, we're not moving off this. We need to have the office. We need to have this control. Blah 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 blah. And the seller thought about it for a week or so and then came back to us, and he selected us specifically because of how we executed the buy. And so it's the building that relationship, being in the market, being a great buyer and investor and stuff like that, that motivated him to come with us to make sure that he has surety of close as we move through this transaction, and he has peace of mind because he's been through this whole time.
Thanks a lot, Chad. Yeah, I'll just kind of reiterate what you just said there too. Like it all comes down to a lot of these sellers sometimes don't always want the highest price. Like they want that, but terms can mean a lot more to them. Having assurance that the buyer will close on time, can bring the equity in place and get it done on time so they can do their next project. That's more important to them a lot of times, which we found out with this current seller. So thanks a lot, Chad. I'll cover the next page here. So one thing we always do in our slide decks is give you more of a sensitivity analysis, a stress test on the deal to kind of look at, all right, this here projects the exit rate assumptions, the exit cap rate assumptions. And right now we're forecasting conservatively a 6 cap on exit, which we feel is pretty conservative. We're looking at, okay, what if we even couldn't get it for a 6 cap? We sold it at a 6.25 cap. And one thing to look at here is if we're looking at the double, we always go for doubles, never, home runs. But on a double scenario, we're predicting a 15% IRR for investors. And let's just say the exit cap rate is 6.25, meaning we can get less on the sale proceeds. So that would only drop the IRR for investors by a little over 1%, which is important to see because that means a lot more of your returns are being derived from the cash flow on the property. And we're looking at these investment opportunities when you can have a higher ratio of your overall return from the cash flow versus the appreciation piece. It puts you in a lot better spot to have lower risk as an investor. The next page here, I'm going to run through just some of the quick scenarios on the return metrics. So this deal here is going to have a limited partner preferred return of 8%. And that means that's what you're entitled to before the general partnership gets their return. So it gives you some safety there as an investor. Projecting a 15% LPIRR between a 2 to 2.4 equity multiple. And I love here about this slide is a lot of investors ask the same question like, how do I get paid and how is it broken down over the years? And the bottom right hand of the screen, it shows you a hypothetical scenario on a $100,000 investment. It shows you how the cash flows are projected throughout the 7 years, starting with year one of the $5,438 estimated. Year two climbs to 6,688 and so forth. And then by year seven, when we sell the property, you'll see a total return from the sale of 190,787 is projected, but overall return plus initial capital is 237,486. So what that means is if you put 100K in the deal, what we're projecting here, if things just go as the base case that they are, you can plan to get the distributions each year plus the gain on the sale, resulting in a total return back of your original capital plus all the cash flow and appreciation of $237,000 approximately. So I hope that makes sense for you guys. But if you have questions at all on that, just let me know. Have to go through it more in detail. Now, Chad, why don't you go through the fun part? This is the fun part with the business plan. Why don't you walk through like what the strategy is? How are we going to increase the value and the revenue of the property, and what will we do at the property itself?
Yeah. So part of it goes back to that story that we were telling about. This developer seller had done management in house, and that definitely caused some issues. And there's been some changes there that had led to the property not operating to its full performance that we see when we bring in our professional third party management and our asset management team and Chris Brown. And the first thing that we're going to be doing, or one of the easy low hanging fruits, is just to come in there, increase marketing activity, and get the rents to market rate because they are far below. Eliminate the concessions and implement a utility bill back program properly, right? And then we should be able to recapture 90+% of water and sewer bill back. And we're already doing that at Heritage, right? We're already implemented that. We're not hitting 90% just yet, but we are on the trend line to do that, even just after a month of owning the property. So those are the first few things that we can do with working with our property management company. And then we plan on implementing, very similar to Heritage, a internet plan. And so we'll do a bulk internet package. Right now tenants use a variety of service providers, but mostly it's Spectrum who's will be doing this work with. And now we get to come in, implement that. We get to make some of the spread between the cost of that bulk internet and the total income that we're going to charge the tenant. The tenant is actually going to have a lower bill over on average and a better quality internet that they don't currently have, is what we've discovered at Heritage. So that's one thing that's going to drive some income. There's another thing in there with common area improvements that we're going to do, and a common area maintenance program. That'll be some other income that hits the line. The amenity upgrades. So we'll do much similar to what we looked at. Each one, both Heritage and this one, been looking at ways that we can improve the amenities offered at the property. So we'll be looking into playgrounds and grilling stations that we mentioned through there. And as long as we can find the feasible site and get through all the city requirements, we'll be able to implement several of those. And then, as I mentioned, there's the office building that we're getting with it. The office building, we're already working with brokers, and we're going to get way ahead of it by 2 months before we end this transaction. That we're going to get it out, get it on the market, and try to get it leased. And we hope to have a lease before we even close. But as the market's shown, kind of that could be possible. And then hopefully cut down on that time that we don't have income coming from that property within a few months after closing.
Awesome. Thanks, Chad. I think my favorite part on that really is the bulk internet program. And what some people don't realize is this is the lowest burden method to the tenant to drive revenue to the property. See, they're going to pay the same price or less for internet they pay currently, but they will be getting a revenue share from the cable provider to boost our revenue and thus boost our value. It's a pretty large increase to our value without us and then paying extra out of their pockets. So it's my favorite part, actually. Let me give you guys a little quick run through on the property, get some visuals here on some pictures. So this property has quite a bit of two beds, some one beds, and some very, very large townhome 3-bed units. That's 155 of the 160 unit on the property. And then we have 5 work live units, which those are essentially studio apartments with a office space in the front. So they've been really attractive for smaller type retail tenants or office space tenants need an office space to live and work at the same time. So this has been great as well. There's only 5 of those on site. They face the main road, not the main common area here, but property has a great appeal here with these townhomes on the top left. And the units are awesome. They've got solid surface countertops. They've got stainless steel appliances, great fixtures, nickel plated fixtures, LVP flooring. They're very, very large units. The bathrooms are great as well. They kept the solid surface countertops in the bathrooms as well. Community center is great, great fitness center there, and a lot of green space for the residents as well. Like Chad Mitchell will be adding some things here in this middle green space, like a playground, the grilling area, and pergola station as well. Chad, let's go over the market overview. Let's talk about the Louisville MSA, what we love about this market, and kind of why we're seeing the growth opportunity with demand combining the starts, construction, the job story. Let's go over that here.
Yeah. Yep. So as you can see, I'll go to the right side first with the River Ridge Commerce Center. It's a big attracting point. It's something that's proven so many times. You can see these things where you pull economic announcement. It's like something in the future. This is a real thing that's already been going on, and it's already pretty down the road, right? So the promise was to deliver 18,000 jobs. They've already delivered 12,000 of those jobs. There's still another 6,000 to come. And from what we've seen in news post, they're going to double down, they're going to expand, and there's plenty of room to expand that entire industrial facility. And that's on the dedicated Indiana side. Not, then we have downtown Louisville, and we're definitely a commutable distance from that. When we were on site yesterday for the start of our due diligence, we did 100% unit walks. We did all of our reporting and everything. All that stuff will be coming back to us here in the next couple of weeks. But talking to the leasing staff, there is a lot of nursing and healthcare interest from the downtown Louisville market, where they are wanting to come over this way and just to get out of the main part of the city and find a good community to live in, but still be in a very commutable distance and access to all of Clarksville, the grocery stores, the restaurants. People are coming over from downtown Louisville to go to the retail in this whole area because it's easier, it's a better location, easier to get around, all that kind of stuff. And so that's been the big attracting point. And so we have that going for us both ways, and just continued growth, continued demand for the area. Switching over to the supply side, and this chart I think is really great at showing what's going on there, is with that demand, with that growth that's been happening there with 12,000 jobs, we saw some construction starts rise, right? And we can see that through 21, 22, and 23 at the bottom of that chart where it got above average for the 10-year average for this exact area, right? But since 24 last year, where we reached that kind of like last end of the peak supply of things that got delayed through the construction, we're dropped. We're down 70%. And this is just Q4 of 24. It's gone down even more from what we've been tracking on the census data the last couple months. So we think that's where we're coming to a head, where we're getting this at the basis that we're getting at, and the story that we're getting at, where they've kind of come through this peak. The concessions were around, lease ups were a little slow, all that kind of stuff. It's all come to a head. This one's at 95. Heritage got to 95. Several of the other properties that we use as comps and stuff that are shown on here, their occupancies have driven up, and a lot of them have reached stabilization. And there's only about 2 or 3 properties that are in lease up right now. No deals are currently under construction, according to this same MMG construction pipeline report. And as far as we know, there's maybe 2 deals from a developer that's headquartered there that has proposals, but those are 2 years out from even getting a shovel in the ground. So that this bodes well for this year, the rest of this year and next year, where we think that occupancies are going to drive right back up, and then rent growth is going to kind of continue to grow. But we've already seen 3 or 4% rent growth for the last 2 or 3 years, and it's been a really strong market in that regard. And we think it's just going to keep moving up beyond that.
Awesome. Thanks, Chad. I'll touch here real quick here on the location of the asset in relation to Louisville, Kentucky, and really the difference between, Kentucky and Indiana. We've seen a lot of people, like Chad said, are migrating from the Kentucky side over to Indiana side, really for a simple reason. And one is the cost of living. The taxes are much, much lower in Indiana versus Kentucky, and the politics or the political landscape is much more appealing on the Indiana side versus the Louisville side. So let's go over as far as the major employers. We have quite a few large employers nearby the property, which can really show we've got some good anchors like Amazon, GE, Ford. So these are some great employers nearby for the residents. And then here's a map here that shows you as well. Chad, why don't you go over this map here real quick for everyone?
Yeah,
Location.
so you can kind of see where Gateway Crossing kind of sits, and this one's a little bit candid. So River Ridge Commerce Center is directly pretty much northeast of where the property is, so we're kind of turned south here. And then you have the Ford and the downtown Louisville that you can see from there. So it's a very easy access to get right on the highway, zip right over the bridge. It's a very low toll and everything, barrier to entry to get over there. There's also several walking bridges that you can move in and out of the city, but downtown Jefferson is an amazing place. As you can see, there's like ACES Technology, PharmaCord over that way. Another thing I'd like to highlight is Gateway Crossing being so closely located to the schools. That's something we noticed with Heritage. We have a lot of families. Gateway Crossing is much of the same, especially with those townhome units. So they're going to have easy access to that. You've got Samtech to the west, and that's another big employer, main employer. And so it's just a really good area in the kind of the central hub. To the north is one of their larger malls, one of their nicer malls, Bass Pro Shop, Lowe's. There's been a bit Veterans Parkway expansion where they have several good retail and restaurants that they've really done a great job at. And there's been a lot of expansion and investment into the infrastructure. Veterans Parkway was a big expansion that allows traffic to move. And then they've been doing a major expansion on one of the roads, I think it was called Blacklick or Blackstone, that will open it up and make it a lot easier to navigate around the whole city and get to everywhere.
Awesome. Thanks, Chad. Touch for a minute here on the comps in the market and kind of where Gateway Crossing sits and what the potential is, please.
Yeah, so I'd like to highlight kind of focusing on the bottom of the page where we have our 1, 2s, and 3s, right? So if you look at our 1s and 2s, which is the majority of our property, we are sitting at average, below average here with the rents where they currently sit. And then 3 bedroom, the reason that we're kind of up, we're still really low. We're the biggest 3 bedroom in the market because we're this townhouse unit, right? So if you focus on that, we're 200 square feet, if not more, bigger than the 2 next comps that are above us. And we provide a way better product and a way different product than a lot of these other ones because these are more of those typical apartments. There's not that many townhome style units provided in the market, especially with the rest of the amenities and the location that we're at. So we think that there's definitely room on that side, but especially on the 1s and 2s where you can see the 2s are pretty far below market. And then as everything kind of comes to a head, and like I said, in that supply conversation, we start to see all that concession burn off and the rents move back up. We're going to be able to fall behind that and still be below some of the highest comps, but drive our rents much, higher than where they're at right now.
Great. Thanks a lot, Chad. Appreciate that. Let me go over real quick here to give you a high level on the Heritage Square investment that we closed on last May. For those of you that may not know about this one, and I'll kind of tell you why it makes sense for us and how it can help the Gateway Crossing property as well as Heritage Square. So Heritage Square was a 183 unit property built in 2023, acquired last past May, 10 minutes away. Really the same story, same seller story, and same property, very similar property rather. Same kind of construction. The unit sizes are roughly the same amenities and same materials used as well. So they both have very, very similar stories, but the advantage here really is that we've got two properties now, 10 minutes apart, that we can share payroll. So in these properties, you've got your office managers, your leasing agents, you have your maintenance techs. And both these properties really are a little in between that size to have two full-time maintenance techs. You don't really need two, you need like one and a half in each property. So now we can kind of shave back one person rather and kind of share three on both sites to be able to manage it properly. Let me run through a couple things here on the sources used and assumptions page. Really, the important thing here is going to be to talk about the debt piece, which Chad already mentioned. We have 7 years remaining on the symbol loan of 3.53%, which is a lot of downside protection here and really kind of eliminates the interest rate risk that most deals usually face. We'll have a second small loan will pair with that primary loan, with the weighted average being in the low 4% range to four and a quarter range. And we'll be around 70% leverage on this deal, which is very healthy size. Again, the tax advantages are an important thing as well. So for a lot of our investors, they can use the tax benefits. Again, consult your CPA. Everyone's situation is a little bit different, and it really is a case-by-case scenario. But because of the tax law passed on July 5th this year, we now have we're essentially double the depreciation deduction the first year we acquire the property. And what that means for this property in your K1 is that we're estimating based upon our early cost seg study draft we have from our vendor that roughly 80% of the investment amount will be a depreciation deduction in the first year of ownership. So consult your CPA to see if you can take that entire depreciation deduction, that K1 loss, on your financials and your situation. But it looks to be a really good opportunity for our investors that can use that, and most of ours can. And last but not least, the GP or my firm will be putting in a co-invest of at least 5% of the equity needed, roughly 350 grand or more on this asset. We always have skin in the game that we have full alignment with our investors. We have a performer here. I won't bore you with all the details. It's in the deck. If you have questions at all, let us know. I think the important thing here to look at is that we've only factored a 3% rent growth per year on average during the whole period. And the reason why it's important is because we're seeing Louisville MSA over 4% rent growth last couple of years. So we're being conservative here, we believe, to where we aren't really going to 4%. We're going to dial back to 3% just in case, give us some room to breathe here, like we always do with our underwriting. Let me cover the team real quick. So obviously you met myself and Chad. We have Chris Brown as an asset manager with us full time. Has a lot of experience with asset management through a Greystar, managing over 3,000 units at one point in time. He's a very experienced guy. He's a great guy for our team. And then Tracy Mendel is an executive assistant. So you'll probably meet her at some point in time in the emails. Let me cover a quick piece here on our track record and our current portfolio. As of right now, we actively asset manage 6 properties today, and we went full cycle on 3 of our earlier deals in the past, and those result in an average IRR of 44%. Again, we can't use past performance to exactly indicate future results, but I hope it's a good indication that the way we underwrite and the way we project our returns and our performance is that we always want to leave a few margins of safety to where we can outperform a business plan and deliver a very healthy return for our investors. So what is next? So here's the next steps for you guys. If you've seen enough today already and you don't want to wait around for the Q&A call the Q&A part, in the chat section is a link to book a call with me directly if you want to do that. Also, there's a link to book your investment online at a very simple cash flow portal. You can click there as well. But of course, I'm available for any questions you have through email or phone call. Let me walk you through the timeline of what happens next. So the next step for you, if you decided to invest in this opportunity, would be to go online to our cash flow portal, investor portal, and it's a very simple process. At that point in time, you'll click the button to invest now. You'll enter your profile information. It takes about 10 minutes maybe. You'll view documents and fund your investment, and then distributions will start. Here's the fun part for you investors: the distributions are planned to start Q4 of this year at the latest. We're planning for Q1 of next year. So December, January, and we want to leave about 2 months of full months of operations under our belt to then distribute and know where we're at with the property's cash flows. A couple things here. So you'll get, of course, you'll have email updates each month from us and quarterly distributions. Those will be moved to monthly eventually, but right now they're quarterly. And of course, K1's delivered to you by March 15th every year. And of course, our team's always available to help you with questions you have, myself and Chad and Chris as well. The timeline. So right now is our open for investment registration. Our funding date is August 31st, the latest date there, or whenever we fill up, whichever is sooner. We're planning to close middle of September and targeting first distributions into this year or Q1 of 26. And we're planning for a 5 to 7 year hold period. We do have a little bit of flexibility there, which we can go over here in the Q&A section. So at this point, let's open it up to some of the questions we have already coming in. So one question I have, or Chad has actually, is based on the square footage of the office space, what is the estimate of what that could potentially add to the monthly revenue?
Yeah, so we would be looking a little over 5,000 in monthly gross income, and then net would be around 2,500 or so. And that's what we're projecting now. We have, like I said, kind of brokers brought in on it and give us some prospectus and kind of their conservative estimates. And then on site yesterday, we did a walking tour. We'll have a lease agreement signed shortly. They think they can beat the numbers that we're holding, but yeah, like we wanted to have, hey, what's the base case of what the market's looking at right now, and that's what we're holding.
Okay, awesome. Thanks, Chad. I have one more here that came in. This is actually interesting. So what co-marketing opportunities exist between both sites with Heritage and Gateway to reduce these costs relative to attracting new renters? So I guess do we believe we can get a discount by using one company in both sites? I personally think we have to do a marketing plan per site individually because of the SEO that goes into it. But Chad, give your thoughts on that, please.
Yeah, I think it's something that's changed in the industry kind of at large, and I think it's something that we've learned in a good way the last year and a half. And whether we were in Kokomo, Richmond, Fishers, or down here, the marketing spend and where people are going nowadays is to that. Like, I think a few years ago, it was still like the old school Facebook, Craigslist, get it out on those ads and stuff. It is getting driven more by this. It is getting driven more by AI. And we've really implemented AI, especially at these properties, with some really interesting softwares that are out there now. So we'll drive the marketing individually at both properties, and we will spend that money, and we budget for it. I think a lot more than a lot of competitors that we've seen recently in conversations that we've had. But we have seen direct benefits from that, especially like on our asset from last year, autumn, now harvest at Kokomo. I mean, we're seeing some really strong leasing activity the last several weeks just because of that marketing activity, right? And so we want to implement the same thing down here. That being said, they are far enough away that they shouldn't compete in a direct way, but they're not far enough away that we, as they're both getting fully leased up, can say, hey, great, we love that you like this property. We know that you want a townhome really bad, or we know you want a one bedroom. We don't have any for another 3 months. Would you be willing to go up to Sellersburg, which is just a short distance away? We can get you in there. And that will definitely lead to some cost on customer acquisition overall. And we'll definitely implement that. But I think we are not going to cut back on our marketing spend. That is something that I think we'll continue to see more spend go into, just to continue to drive traffic, continue to drive renewals, and then market rent increases overall.
Yeah, thanks, Chad. Yeah, marketing is so important. We see a lot of mistakes that sellers make as they pull the marketing back to save money. And marketing and business is your most important thing. You have to get leads coming in the door and fill top of the funnel to get tenants to come in to those units. So that's great. Thanks, Chad. Another question is, do you have any concern reselling this property in years 5 to 7 since you were able to buy at a lower cost per door as you considered it to be a distressed sale? Also, why do you think he had trouble selling this in Heritage Square? I think we kind of already discussed the trouble selling at Heritage Square. He came out way too early at a too high of a price, wasn't stabilized yet, shrunken buyer pool. And we know firsthand there was a couple of groups that saw Heritage Square early on, but then passed on it the third time around, and they wondered kind of how we got at that price. So really is the story of like keep your nose to the ground as a buyer and have a good reputation. But Chad, go ahead and give a little more light on the first part of the question, please.
Yeah, I think it goes it's basis all the way through what you're getting it on the buy, and that's where you make your money on the buy. And being at 140K a unit is really what I like to focus in on, and it's kind of goes to the same thing on our exit scenarios. The cap rates are one thing to definitely focus in on. They're ever important, especially with the way our model's set up. But that exit scenario that we have at a six is exiting around 180 to 190 a unit. And as I kind of laid out there, we have deals right now that are trading for exactly that price, and they're only going to move up over time. And we're seeing that in the rest of the market. So to say that 5 to 7 years from now, we're going to exit around that price, same thing, kind of focusing on price per square foot around 180 bucks is feels really, really safe, really conservative, and something that we can outperform. I think the other thing is to kind of highlight on the 5 to 7 years is in that we have 5 to 7 years to kind of execute this business plan, right? So 7 years is a long time, a lot of market cycles to go through. And if it's why now that we got it for this price, it's because at this moment, as you said, he wasn't stabilized. He was working through a market cycle that wasn't as advantageous. If he would have sold 2 years ago and was stabilized, he would have hit it. He would have hit the peak, and we'd be seeing a case study about selling this thing at a crazy basis and all that other stuff. But it's that difference in the last few years of how the market has really shifted that, 6 months before, 6 months after, okay, rates spiked, this spiked, debt costs got worse, all these things kind of changed and shifted. And so that's why we were able to come in and get it where we did. We're going to have the room in that timeline to be able to find the most opportunistic time to sell, which is why we also highlighted the fact that we have the 5 to 7 year range. In the event that we have, in the event that we overachieve the business plan or achieve it on a high end and we get to a lower interest rate environment over the next 3 to 5 years, if we get an offer that's at our exit that we're looking at, we'll definitely think about selling it at that 5 to 7 year mark, as long as the pro forma and everything, and we can give the returns, if not better, to our investors at that time. But we know we have the run rate to go to a full 7 years. And I think that gives us enough time to execute the business plan, get this truly stabilized, let the expenses and income work the way they're supposed to, and show a truly stabilized multifamily property that's running efficiently. And it's something that a long-term holder will want to pick up and a more institutional buyer.
Thanks a lot, Chad. It actually goes into our next question we have is how do you see the exit opportunity having two properties in close proximity via getting a higher sales price from an institutional investor? Meaning, is 340 units big enough for their appetite? And the way I answer this question is I look at this and talking to some very experienced brokers that saw this deal back in April and May. I was talking to her about it, and that was what she brought up is because she sells to these big buyers. They're looking for how can we get over 200 some units in one area, and that's going to bring more buyers into the buyer pool. So we're looking at this as like it's not really aimed at getting a higher price, which that definitely could happen because a lot of times these buyers do pay a lower cap rate, meaning higher sales price or purchase price rather, for these larger properties. But we're looking at this as like we could actually get a lot more exposure and widen the buyer pool and really maybe create like a bidding war. But again, taking a step back from that, remember, like our primary objective here is to keep the business plan on a singular basis with this one asset on a 5 to 7 year business plan. That's option A to sell. And then the option B would be we could potentially sell both deals together. So it's really cool having two different options here with our exit strategies. I've got another one here. Are you concerned that the market is saturated since there is a moratorium to stop building in the area? Good question. Chad, take that one, please.
Yeah, the moratorium is more indicative of what's to come and getting into a better place. As I showed on that kind of a few pages back with the construction and how much they've fallen off, we hit that peak supply. And because that supply was delivered, that's why they've implemented the moratorium, amongst other reasons. For example, in Sellersburg, that happened first where we bought Heritage, a lot of developers come in and convince the town council, maybe because they weren't so sophisticated or didn't fully understand, to convert retail or industrial, that kind of land that they had kind of planned out to be something else into multifamily. And they're like, well, we want to catch up here. We want to put in more retail here or these kind of services or whatever kind of real estate. And that's up to the town and city planners. And so they wanted to pull some of that back. So the moratorium happened there. The rest of them are starting to pick that up in New Albany and Jeffersonville and so on and so forth. But it's just because so much was delivered at one time. And they're very reactionary and kind of slow to it. So we've already hit that peak. Now we're falling off and then they implement it. And it's like, okay, well, that will really draw things down. That's part of the bullish story that we think because they'll be also slow to turn it back on. And so we probably will have a few year lag before anything really could come back if we started to see the big rent growth, which is what attracts developers back to the market. Um, and so we actually think it's a good thing that gives us more barriers to entry for any new supply to be added on without us having a lot of good planning around it.
And thanks a lot, Chad. Like Chad said, like there's nothing currently being developed. It's market rate, nothing permitted, currently market rate, and there's two projects that are being proposed, and that's a very loose term. So there could be something happening in the next couple of years, but highly unlikely. But either way, it puts us in a really good spot here with the current supply and demand story. Next one here. After walking the property, are there any items that you think need maintenance right away due to lack of attention or normal wear for the age of the property? We were all on site yesterday, doing unit walks, walk the whole property, and there's a couple of things that stood out to me in particular that I'll address. But overall, the property really inspected pretty well. And it's pretty normal to have a couple of units where people have a lot of stuff in there, or maybe they didn't take care of the units. Pretty normal. But overall, the construction was great in the property, just like Heritage Square was. So for us, it's more of a rinse and repeat. It's same developer, same builder, great finishes. Construction is great as well. We did notice that on the door frames of the property, they must have only used primer paint on those. So we noticed there's quite a bit of like chipping away or weathering on those door frames. So we're going to have part of our business plan, CapEx plan will be to seal and paint all those door frames, door jambs to prevent any kind of moisture from coming in there. And of course, there's some broken blinds here and there from residents. So we'll be implementing a plan to get that repaired and replaced and implement a plan for them as well to where they'll be responsible for damages if they do damage blinds in their units. Chad, you saw a little bit more than I did there. So what did you see yesterday on site?
Yeah, it's I think the door frames were the thing that stood out, right? Because that didn't happen on Heritage. Heritage is a little bit newer. Now we know, hey, we need to watch if that was the same issue that persists. But you can see exactly where it is. It's like 2 feet up. So it's where the rain, it's where the sun, it's where everything can kind of hit it. And most likely what it was is that there was just one coat applied and it just needs to get touched up and it'll look a million times better. And then there's some things on the roof with some pans and how they were set up and everything else. We saw the same thing on Heritage. It's a very easy fix. It's covered under warranty. The roofer will be out there and fix everything else. But we already knew those going in, got our construction guy that's with our third party management. He already knew, already had it quoted, already had it planned out. But I think it kind of goes to the same thing, which is we have, over $200,000 in CapEx reserves that we're holding on this property. So we're very well reserved on this property for both CapEx and OpEx because this is always the plan. We want to be set up for this thing to be a long-term cash flowing asset for our investors. And so we're ready for a lot of those different things that can happen. And we're still going to be building up reserves, that being said, afterwards, as part of our plan and holding that back every year to handle any kind of things that come up. But buying a new vintage property overall is already limiting that risk and by a lot. And we'll have 5 to 7 to 10 years before bigger things start to happen. But we're well prepared for it.
Thanks, Chad. Another question here came in is where is the upside? I'm used to value add deals. I actually love this question because I feel like that kind of is the point of this deal is we don't have to do value add to get the returns. Like value add's fun and all. We do that really well. We have in the past, but it's really special when you can take over a property, acquire one at a low basis where really the business plan and the value is really in operations and just acquire a deal at a low price. And that insulates you from risk because that way there's no risk to renovations, risk of timelines, risk of some huge rent bump, or risk of cost overruns. And that's really the beauty here of this deal. So we feel it's a good opportunity for a core plus deal and you're really getting value add type returns without all the work. Um, Let's see. Are we committed to a 7-year term? Discuss exit options. We already kind of discussed that. So no, we aren't committed to a 7-year term. We have 7 years left on the note on the loan, the assumable piece, and both loans will be running concurrently together for the same end date on the loan, both loans rather. But again, we're open to between a 5 to 7 year timeline, kind of depending on where Heritage Square sits in 5 years. If both look to be good together for a sale together at that point in time. We have a couple different options there as well. And we've seen most times our limited partner investors, they do like the 5 year timeline, 4 to 6 year timeline, sorry. So that gives us a lot of runway here to finish the business plan properly. Is the income from the offices considered in the financials? And are they part of the 160 door count or in addition to this number? Chad, you can take the income piece. It is in addition to the number. So it's 160 units plus the office itself. Chad, you want to cover the income as well, please?
Yeah, I mentioned kind of what we're projecting in income expenses and net income from it, but yes, it is reflected in the pro forma.
Okay. And we've also been in touch with several brokers already. We feel like it's a very realistic number. One broker gave us a lot higher number, so we're going to err on the lower side and keep it more realistic. And if we outperform that, then great. If two people want to invest together through an LLC, do both people have to be accredited investors, or can the LLC still invest if one person is accredited? So I'm going to give you the official answer here. I looked up a while ago, and both people would have to be accredited if they're in the LLC. If you have a specific situation like this you want to discuss with me, please give me a call directly, email me. There might be some of the way we can format things or structure things to make it feasible for your investment, but let me know on that directly, please. Are these set up for government subsidies for rents? And that should be no. There's no government subsidies here, correct, Chad?
I mean, it does the rents that where they could qualify for Section 8 just because of how much
Okay.
Section 8 stuff has moved, and we're not, we cannot deny, but so we would do that, but there's nothing like we're not going to go out with a full-on program or do anything like that. But we've seen that in Carmel, we've seen it in Lebanon, we've seen it in Noblesville, like, those levels and those limits have moved up quite considerably that they are pretty much in line with market rents. And so that could be an option, but it's only in that vein. And part of the reason we're getting some of the most favorable debt quotes is because this is still mission driven, hitting those lines. But it's more of a testament to how much room we have in the rents via the median household median income that's in there. There's a lot of protection there.
Awesome. So great explanation there, Chad. So currently today, there's no one getting Section 8, but there could be in the future, but that's not our plan at all. Our plan is to keep it market rate. Um, Tax benefits covered that, depreciation deductions. Yeah, cover that well. And you get with your CPA as well if you have questions on that, guys, to see how it could pertain to your current situation. And then how does the investment process work? What do you have to fund? Again, go to the link in the chat or in the emails we've sent you already, just to go to the registration portal online. It's very simple. And then you need to fund within about a week or so of signed documents. As of right now, we're about halfway through on the capital raise. That's where we're at today. Um, and then last question I have so far, if you have more questions, guys, let me know, put it in the chat. We have, does adding things like playgrounds or grilling stations add any increased liability and associated insurance costs that need to be considered? That's a great question. Chad, any thoughts on that?
The there could be some increases, but kind of the trade-off is worth it for sure. Even on Harvest, we have all of that and the above. We have a pool too, and our insurance premium is not significantly more. We have a great insurance broker, luckily. But we need to provide more amenities to these communities. That's a big driver, and we have a lot of families, so the playground will be very important, but it's something that we are evaluating with the insurance broker about what the impact is, but it's usually generally negligible. And it's definitely worth adding the amenities.
Awesome. Thank you. Great question here from another one. What is the biggest risk and worst case scenario? It's actually a great question to ask because I love when people ask about the risks involved. It means they're really thinking smart about investments. So I did a video last week about the top three risks on this deal and ways we mitigated against that. I'll kind of highlight them here real quick for you guys. One is interest rate risk. That is a very common risk that most people face in real estate, and we mitigated that by having a very low fixed rate assumable loan. The second risk really is market or occupancy risk with the property. And we feel like that's mitigated as well with the low supply coming in and the demand from the extra jobs being supported in the area. And the third risk really is your exit assumptions. Like, what's the risk if you can't sell it in 5 years or can't get that sales price in 5 years? And again, we feel like we've mitigated that because we've forecasted a six cap on exit with some room to stress test that as well, with other options to refi later on or keep holding it if it's not proper to sell. But Chad, why don't you give your thoughts here? What, even with those mitigations of risk, like what do you think is the biggest risk right now in this deal? If you had to paint the worst case picture, what's the worst case scenario?
It's that the supply dynamics that have existed persist longer than what, we're already seeing and what we could see. So if that kind of kept going, that being said, it's not gonna we've already seen the worst of it. It's not going to turn a corner the other way. What we'll just see is more persistent concessions and kind of leveling off of the rents. But we still are far behind the market with rents, and we have a long run route to get to the other side. But I think that's truly the biggest risk. The jobs across it, because we're located in a major MSA, is pretty well covered. Whether even if River Ridge was to stop, we still have downtown Louisville to go to. But it's mostly just kind of like a longer duration of that supply persisting. But it's hard to argue with the numbers at this point with construction starts going about how they have. And then what we're seeing with lease ups hitting and max and then concessions burning off right now.
When you were discussing that, Chad, thanks by the way. I went back to really the basis discussion, and that's where I feel like we've really protected ourselves in these downside scenarios because of the basis we're buying it at. If we had bought this property at say 20% more, I'd be a lot more concerned with what could happen in the future because we have a lot less margin for safety there. But because we bought it at such a low price and we have a higher ratio of return come from cash flow than what would be expected normally for a 4-year-old property, well, there's a lot more that can go wrong and still break even. So we always run a break even scenario with occupancy. Like what does actually have to drop to just to break even? And it's in the low 80% range, which is pretty low for a property this type. So hope that helps you out there. If there's any more here, let me know. I think that's the end of the questions so far. But thanks a lot, guys, for your time tonight. A lot of you guys stuck on for almost an hour, went by pretty fast. So thank you so much. And again, if you have a question at all, reach out to me directly. You can email investors@focuscapital.com. You can email us directly. You can call me directly either way. But I'm happy you joined tonight and looking forward to the next path ahead. Thank you so much.